Hello, and welcome to today's episode on reinvesting passive income and the strategies that can make or break your financial journey. A few months back, I was sitting on my back porch, laptop open, sipping on what had become a cold cup of coffee. My heart was beating faster than I would have liked. You ever get that feeling where you think you've got it all figured out, and then, boom, the rug's pulled right out from under you? Well, that was me. I had been reinvesting earnings from my passive income streams into what seemed like rock-solid opportunities, but things weren't going as planned. It was like hitting a wall after sprinting for miles, and it was frustrating. The morning sun was casting these long shadows across the yard, but all I could see were the red numbers on my screen. They were a stark reminder that even the best-laid plans can hit unexpected turbulence. So, let's rewind to January. I decided to take a leap and diversify my passive income portfolio. I was already dabbling in dividend stocks and rental properties, and they were doing okay. My dividend portfolio was yielding about 4.2% annually, and my rental properties were bringing in a steady cash flow with an average cap rate of 6.8%. But you know me, I wanted more. I was itching to hit that sweet spot where my money would be working harder than ever. I was inspired by stories of investors scoring double-digit returns with strategic reinvestment. So I went all in, reinvesting every dime into new projects without a second thought. In hindsight, that enthusiasm was both my strength and my Achilles heel. It's amazing how the thrill of watching your wealth grow can cloud your judgment. They call it overconfidence bias, and it's a trap even seasoned investors fall into. Initially, everything seemed great. Numbers were climbing, graphs were trending upward, and I was feeling like a financial genius. My REITs were performing spectacularly, posting gains of 12% in the first quarter, and my dividend growth stocks were showing serious momentum. But then, I got a call from my friend Sarah, my go-to for financial advice. She casually asked if I'd heard about the market dip. My heart skipped a beat. I hadn't. It's funny how life-changing news can hit you in the most mundane ways. Sarah explained that the market had taken a hit, affecting several sectors, including those I had just invested in. The tech sector, where I'd allocated 30% of my reinvestment capital, had dropped 8% overnight due to regulatory concerns. Real estate investment trusts were facing challenges from rising interest rates. I was floored. My first instinct was to panic, but I had to stay calm and analytical. It's interesting how our primal fight-or-flight response kicks in when it comes to money, right? Emotional reactions can be costly in investing. I spent the next few days buried in financial reports and industry analyses, trying to unravel what went wrong. Was it a mistake to reinvest so aggressively? Should I have held a larger cash reserve? These questions haunted me as I sifted through quarterly earnings reports. Federal Reserve statements and economic indicators I had previously brushed aside. I realized I'd overlooked the importance of understanding cash flow. It's not just about the returns, but really grasping what's available and how it circulates through your financial ecosystem. Many beginners, and yes, even folks like me, focus solely on returns and miss this crucial aspect. The difference between accounting profits and actual cash flow hit me hard as I watched my paper gains disappear while my liquid reserves dwindled. In my rush, I hadn't accounted for potential risks and market volatility. Rookie mistake, right? Yet this became a turning point for me. Market volatility is a persistent factor, with the VIX index, often called the fear gauge, showing elevated levels in 2025. It's higher than the usual 19 to 20 range, averaging around 27.5. Geopolitical shifts and policy changes like tariffs have made staying agile more important than ever. I consulted with industry experts and reevaluated my strategy. I needed to balance reinvestment and liquidity. conversations with financial advisors highlighted the barbell strategy, which combines extremely safe investments with high-risk, high-reward opportunities while avoiding the mediocre middle ground. One thing I did right was diversifying my income streams. By not putting all my eggs in one basket, I mitigated some losses. This wasn't just luck. Studies consistently show that diversification can significantly reduce portfolio risk. Research indicates a reduction of up to 56% compared to undiversified portfolios. Modern portfolio theory, developed by Harry Markowitz, demonstrates that combining assets with low correlation can optimize returns while minimizing risk, a principle that spared me from disaster. I also started exploring top platforms for passive income to find safer options for my next moves. The emergence of new fintech platforms offering fractional real estate investing, peer-to-peer lending with enhanced risk assessments, and AI-driven portfolio management has opened up unprecedented opportunities for individual investors. As the dust settled, I found myself back on track, a bit wiser and more cautious. The recovery took about 6 weeks, during which I implemented a systematic approach to rebuilding my portfolio. I learned that reinvesting earnings from passive income isn't just about chasing high returns. It's about timing, understanding market trends, and maintaining a buffer for unexpected downturns. Think of it as building a financial fortress, not just a skyscraper. Fortresses are designed to withstand sieges, while skyscrapers, despite their impressive height, can be vulnerable to strong winds. I incorporated stress testing into my strategy, imagining worst-case scenarios and ensuring my portfolio could survive them. In the end, it's about timing your reinvestments strategically. Assess market conditions and align them with your financial goals before making decisions. Reinvest when opportunities match your risk tolerance and long-term objectives. Even in 2025, with its mix of optimism and uncertainty, understanding broader economic indicators is key. So, whether you're just starting out or you're a seasoned investor, remember to stay balanced, diversify, and always keep learning. Thanks for tuning in, and until next time, take care and invest wisely.